Welcome to the ARMR Report, ladies and gentlemen. Thanks for joining me. This is a Wednesday night. It's September 16th, and this is going to be an ARMR education video, okay? I am going to break down for you a mistake that I made recently that cost me the opportunity to make money. Now, this is a show about stock market investing. Those of you who know me know that the ARMR report stands for Algorithmic Risk Management Research. Okay? So this is a show about what we call quantamental investing. It's the combination of quantitative analysis using algorithmic information, and we put that together with a fundamental foundation, and that's the information edge I share with you every time I come on this channel. Thanks for joining me. I appreciate it. Couple of thoughts real quick. If you enjoy this, give me a thumbs up. That always helps. Don't forget down here you can subscribe to this channel on YouTube and, of course, the ARMR Report. Now, the ARMRreport.com, ARMR report.com, is a deeper dive into exactly what we talk about every time I come on this channel. All right. So if you'd like to be part of a one-on-one opportunity to chat with me or part of our ARMR Slack trading desk where we're on all day doing exclusive videos for ARMR insiders and sharing information, think about it. Just if you think it's something that would work for you, right down here, take a peek. Now, a couple of quick notes. Don't forget, I don't know you, so I can't possibly tell you how to invest. Okay, so what I'm doing, particularly on these education videos, is I'm trying to share with you, I've been doing this over 30 years. I've got successes and I've got failures. And I like to try to share both with you. Okay? I want to share with you the battles I've been in so that you can win the war yourself. That's what I'm trying to do. Okay? And so it's real fun to come on here and talk about successes. I mean, that's, let's be honest, it feels good for me. It's fun. I enjoy doing it. But then there are times, look, integrity is important in every career and anything you do in life. And I take it seriously myself. And so there are times when there's a glaring mistake that I've made, and I want to share it with you. Not just so you can learn, it's just also from an integrity standpoint. It's just, if I'm going to get on this show and talk to you about the money we're making, which we do a lot, I also want to come in here and be honest with you and say, guys, sometimes we miss it. Okay? And that's what this show is about tonight. So what we're going to do is break down a case study of the recent ARMR investment into DraftKings and out of DraftKings before the stock went up. Okay? That's what we're doing tonight. So the ARMR report we have listed for all ARMR insiders, an ARMR portfolio page. You can go in there and you can see what stocks we buy, the prices we pay, the date, and what our stop losses are. And we have 3 different stop types. We use our principal protection stops, which is what we put on when we buy an asset. So we know exactly what we're willing to lose if it goes down. Okay, so we know what our loss is going to be even before we ever buy it. Our raised stop approach, so once the stock goes up enough, we raise our stop so we don't violate one of those golden rules of investing, which is you never let a gain turn into a loss. Okay, so you got to raise your stop. And then, of course, the most fun is the trailed stop. When things are working and they're blowing out, you trail that stop and you hold the stock as long as you can and ride that winner until it stops out. So, I want to go over for you the single biggest mistake you can do when using stops, in my opinion. And while I know this mistake, and while I'm the author of this thought, I still make it. I still make the mistake. So, investing and the process of learning how to invest, it's something that never stops. I mean, truth be told, the reason I created this YouTube channel to begin with a couple years ago, even before the ARMR report, I just started doing this honestly to be on record and help myself execute more. Because when I talk to you about it, and I share with you what the process is, it reinforces for me that I've got to execute that way. Okay? So I really appreciate you guys spending time today on a Wednesday listening to this, because hopefully it'll cut down the amount of times that I make this number one mistake when using stops. Let me say that I'm prone to make an error like this because the ARMR report is all about managing risk. And so what I like to say is the best way, if you did nothing else but the one thing I'm about to say, if this is all you did all year long, I submit to you, your investment performance would improve. The one thing you have to do is stop losing money. Just stop it. Stop going on tilt and giving all your capital away because you fight the market and you're sure the asset's going up and you thought it was a great piece of news and why isn't it happening? You lose more and more money. If you just stop doing that, keep everything the same, the end of the year net worth's going to go up. And the best way to do that is to use stops. Okay? So what I like to say at the ARMR report is we're about protecting capital first, capturing upside second. And so this mistake that I made on DraftKings, I've made before, I'll make it again, but I try to cut down this mistake. I try to limit it. So now let's go and take a look at this case study. You're looking at a chart of DraftKings. I marked it up for you where we bought it, where we sold it. Okay? Now for those of you who are beginners and you're not sure what a stop loss is, briefly let me explain. We bought the stock on this day right here. Okay? We're using the 50-day moving average in this case on the stop. Now as an ARMR insider, you can go to our website, look at the ARMR portfolio, pull up the spreadsheet, and I say right on it what stop we're using for every stock that we buy. And I update that sheet as the asset progresses. So on that sheet was the 50-day moving average as the stop. Okay? So show me here on the chart. I want you guys to show me. Did the stock ever go below the 50-day moving average, which is this dark blue line? Okay? And when I say go below, I'll take it a step further. I don't stop something out in the morning. I generally don't stop something out in the middle of the day. The stock has to close below the stop for us to execute. So it's not a hard stop. It's not a stop we put into the market. It's an alert. You can do this with any trading software you use. You put the alert in. When it hits that stop price, you begin monitoring the situation, and by the end of the day, if it's below your stop, you're out. Sometimes that means you lose a little bit more. Other times it means you stay in the asset because it reverses higher by the close and you make a lot of money. Okay? So, where on this chart did DraftKings close below the 50? It didn't. It never closed below the 50. So why on earth was I selling the stock on the 31st of August? It never violated the stop. The single biggest mistake that I do, and I think a lot of people do using stops, is they put their stop on. And actually the mistake breaks down into two things. Number one, they anticipate the pain of that stop. They don't like it and they execute before it gets there because they think it's about to happen. Like somehow they know what's going to happen tomorrow, right? Nobody knows. Clearly I don't know what's going to happen tomorrow. I tell you guys that every time I do this show, right? We're about probabilities. We're about getting on the right side of probabilities every day when the reward's worth the risk. And what I like to say to ARMR insiders, on the website, I've got a page called ARMR Investing Rules of the Road. And I'm just putting on that list. And I'm really building it for my son and my daughter. And I'm sharing it with you guys right now. My son's 7, my daughter's 3. So we've got time. So I'm building this list. And on the list, I say to you, I think it's number 10. And I'm going to just paraphrase. The number 10 on the list, or it could be number 13, you come up with your investing strategy when the TV's off, when the market's closed, and you execute ruthlessly the rest of the day. You don't care what you hear on CNBC. You don't care about fears from friends you're talking to or things you're reading, news stories that could change the situation. You tune all of that out. You put your trade on. You knew what your stop was. That's it. And you step away and let it unfold. Now, I can tell you exactly what happened. Okay? I can tell you exactly what happened this day on DraftKings. The stock ran up a little bit, and I convinced myself to use the 25-day moving average as a stop. Now, the reason that's a mistake, okay, and now I'm getting a little bit deeper into the minutiae here, but you don't really change your stop when you're so close to a major location. The 50-day moving average, the 200-day moving average, these are major locations. They are always going to dominate your stop decision. In other situations where the 50 and the 200-day or the 25-day begin to separate, then you could start using the 25. So look back here, okay? Let's say we owned DraftKings here. It starts to take off, it starts to run. We're not going to use the 50 as our trailed stop because there's too much room between that and the 25. Between the 25 and the 14 is too much room, okay? So you raise your stop as the moving averages begin to fan out. But when they're this tight together, okay, you never change that stop from the original stop. So number one, I tightened the stop. Why did I tighten it? Because there was news stories that day. Shame on me. Guys, I'm embarrassed. I'm literally embarrassed to tell you this. I mean, really, there were news stories that day. Something ridiculous. I don't know if it was, college football talking about not playing or something. There was something going on that day. I can't remember what it was. Maybe it was the NBA deciding to boycott or some ridiculous story. Okay? And so I looked at the position and I looked at the stop. And I said, I'm just going to get out of this early. I'm just going to get out. I don't know what's happening. I don't like what's happening. I'm going to raise my stop. Okay. But clearly in retrospect, the stop was the 50 when we bought it. The stock should have remained the 50. And of course, we would still be in the stock now making a lot of money. And we would have been able to transition to a trailed stop at this point. Okay. Now, I can hear somebody saying this. Maybe it's DJ if he's listening to this right now. And I agree with him. Absolutely. I got stopped out here. I could have bought it back here or here. It's true. I had time to buy the stock back and make that decision. Okay? But I exited the position and I didn't step back up. The bottom line is never should have exited. So to wrap up this thought, and thank you for allowing me to share this disappointment with you. The worst thing you can do when working with stops is to change that stop in the middle of the trade for some erroneous reason. You set up your position, you come up with your stop that you're comfortable with at the beginning of that position, and you stick to that until you get stopped out. That's it. Okay? That's it. No news story, no friend talking to you, whispering in your ear, no CNBC guy chatting away has anything to do with the decision. Okay? Don't overthink it. And as a subset of this, if I were to say the second worst thing you could do with a stop, is make the stop too tight. you may as well just sell it. If you're going to make the stop so tight, you may as well just sell it, because the HFT algos will root out that stop and take you out. Okay? So you need to find a reasonable stop, which we can help you do at the ARMR report. We do it all the time. Okay? And then stick to it. And those are my thoughts for tonight. Thank you for listening. I will take some questions now. What do you got for me, guys? Alex, hello. Nice to see you. Please review. Okay, Q, Apple, Microsoft when possible. Q's Apple and Microsoft. Okay, I will say that the ARMR investing way, as you already know, Alex, but I'll just share it with anyone listening now, is about a three-step or a three-stage process. The first is building our whiteboard of names that we want to own. So that's the fundamental piece. The second is the execution piece using algorithms. So if you listen to me on Saturday and you know from last week, the algorithms we have written on the top 7 indexes that we use to drive all of our risk decisions, if you just, I try to make it as simple as possible instead of going through all the minutia. The bottom line is it red, green, or yellow, right? When it's green, we're putting a lot of money to work. Yellow, we're just managing our success and cautiously putting money to work. And red, we don't put money to work, okay? So right now it is red and nothing's changed. We had a couple up days early in the week. We sell off today after the Fed meeting. The market is working on making a new base. So nothing's changed in that regard. And so let's share a screen here of the Qs. The Qs, Apple, Microsoft, all have the same type of setup. You have a big sell-off that was aggressive and happened quickly. Okay? Those don't usually erase themselves overnight. It takes time. Corrections happen in either time or price. Okay? So it's going to take time, and nothing has happened this week that changes the algorithms that say it's time for us to start putting money to work yet. Here's Microsoft. Okay? It's the exact same chart pattern, almost a little bit worse below the 50. And there's Apple a little bit above the 50, maybe a little bit better. But still, this is a terrible pattern, guys. This is a blow-off top after a stock split. Let's be clear about that. Stock split, and everybody ran into it because they thought it was cheap, when really it doesn't work that way. And then the stock is selling off. That could easily be a top in Apple. So you need a pattern better than a couple of weeks to want to put that stock away again. Okay? Tech Monkey, how are you? Nice to have you. I really respect your honesty. Oh, thank you for that. I appreciate it. Thank you. Do you have any thoughts on LCA? LCA. No thoughts on LCA. Other than to say this, I never buy blank check companies, ever. I don't understand why anybody does. I don't know what the appeal is. It's a blank check company. They can do whatever they want with the capital. It just doesn't work for me. Okay? Justin, how are you, my friend? It was the Morgan Stanley downgrade. Oh, maybe it was. That was another piece to the puzzle that day. Morgan Stanley's downgrading it, right? Who cares what the analysts say about a stock? Upgrades, downgrades, it means nothing. The stock stays above the stop, we stay with it. I don't care what an investment banker has to say about it. An analyst. Give me a break. All right, guys, any other questions? If not, I'm going to sign off tonight. I appreciate you spending time with me. I'll give you a couple more seconds to load up that chat board. Any thoughts on GE? Alexander. I haven't thought about GE in the longest time. Look at that chart pattern. Huh. Well, here's my thought on that. Alexander, here's my thought that I would like to ask you to think about before investing. What is the catalyst that's going to turn that stock around? See, I don't mind buying value, okay? In fact, the ARMR investing way, if you look at our, we have a 3-step process, 3 stages, I like to say, right? Build the whiteboard, number 1, execution, algorithms, number 2, stop loss management, risk, number 3. So under number 1, which is build our whiteboard, which is our list of stocks we want to own, we break it down into 3 separate types of stocks. One is your growth, momentum type, William O'Neill, Investors Business Daily type of approach. The next is value for a reason. Okay, and the third is a Peter Lynch approach. But we're talking about value for a reason. So if you think there's value in GE, there's got to be a reason, a trigger, something that's going to bring institutional capital back into it. So far, I haven't seen anything that I believe in that will do that for GE. And so I avoid a stock with a 9 relative strength. I'm looking for a stock with a 9 in relative strength and a little O after it. Okay, a little 9-0. Okay, I'm looking for relative strength stocks 80 and above because I'm generally a William O'Neill type of investor. But I'll stray, I'll do value, but you got to show me a reason for it. Okay, and I don't see it there. Chuck, Brett, thanks a lot. More clear on stops using the 50. Much appreciated. This is exactly the thing that happened today. I'll set up an alert rather than a hard stop. Oh, excellent, Chuck. I'm glad that helps. And Chuck's an ARMR insider, so we were talking about that today in the Slack room. I'm glad you helps. David, any thoughts on Fox? Not really, but I would say this is my thought on this particular issue. Take a look at the O'Neill chart, okay? This is going to be true for Fox. It's going to be true for the new issue Snow that was out today and any other new issue like that. I don't generally invest in any type of a new issue. I know this was probably a spinoff, right? I like to wait at least 6 to 9 months before I start putting money to work in a new issue. And the reason's simple. I use I use algorithms to drive my risk decision, and they're all based on probability and statistics. And so if the stock hasn't been public long enough, the statistics I'm coming up with aren't valid. Okay, so that's one reason. But the other is there's just a general overhang when a company comes public or gets spun off. Very often there's guys who want to get rid of it, in a spin-off. I'm not sure this is a spin-off, but if it was, you're going to have some institutions that get the shares, they don't want it. And so this could take 6 to 9 months, sometimes even 12 months, to build a base that looks viable. And Fox hasn't done that yet, so I don't really have much of an interest there. Tech Monkey, noticed that YOLO had a large holding. Oh yeah, BlackRock Treasury. Is that a good thing? A large holding of treasuries? I don't know why that is, and I'm surprised if that'll stay there for very long. So how long have they had that holding? I'll have to do some research there. Maybe we could talk about it on Saturday. I know I see you a lot on Saturday, and I appreciate that, by the way. Let's take a look at YOLO. Honestly, guys, I just don't see it yet in cannabis. I keep looking and waiting for an opportunity, and I just don't see it. There's MJ. These stocks look horrible. So what's really the reason that everybody, I guess I don't know about you, but the reason I want to own these stocks, we get some type of legal change here in the U.S. and these stocks just skyrocket, okay? I would submit to you that I'm almost to the point where I think I could just buy the gap up that day and make a fortune and not have to wade through this headache of waiting for rules to change. I honestly believe it. The day they actually change the rules, these stocks will be up huge, and that'll be the beginning of massive influx of institutional capital that'll put these stocks to the moon over a series of years. So what if I don't get the first day? I mean, I'm literally to that point. I mean, honestly. But I'm sure I'll play again in the space. I love the space. I believe in the space. You know, one reason to own it now is what happens November, right? If you get, you know, Democrats to take over, then obviously this is a great hedge for the rest of your portfolio. Okay. So I don't know, but I'm just not there right now. Oh, Oliver, you were asking about FedEx. Well, I talked about Fox too. Oh God, FedEx, what a miss. Oh, how did I miss? This is a night for talking about what I missed. Apparently, what a no-brainer FedEx was down here as it broke out in that first earnings announcement there. And then we started to get a turn, right? The economy, not even the economy. Clearly, people were FedExing everything under the sun because they weren't leaving their house. And so that's what this rip is. I mean, if you already own it, that's great. I mean, let it keep going and trail it up with a stop. There's no way I'm buying it up here, right? So I have to admit when I've missed the right entry point and wait for the next entry point. Yeah, I know, Tech Monkey, I know YOLO's holding IIPR and GWPH, and so I submit to you, why not just buy those stocks? Because maybe those stocks are the best. Why do I need YOLO? Because there's a whole bunch of junk in there from YOLO. So, you know, true, I've been looking at GWPH again, you know, and the reason for that is it looks to me like Biotech could have turned. It looks like Biotech just turned this week. Had a major rip off the bottom, closed above the 50-day moving average. So if Biotech starts to look good again, you know, possibly GWPH is going to look good. You know, IIPR is a weird animal. I got off this stock a while ago. Obviously, that was a mistake. But, you know, the day they actually approve safe banking is the day this stock should literally go down. I mean, right now, they're knocking down huge ROI because it's hard for U.S. cannabis companies to raise cash. The minute they change the rules, theoretically, the stock should go down because they won't be able to write business they can drive a truck through like they can now. You know, the amount of deals in their pipeline should go like this if companies can now access capital at a lower interest rate through banks. So, you know, I don't know. All right, Brett, hope all is well. Just sold GDX for WPM, wondering your thoughts. Butch, I love that idea. You know, I love that idea. I think Wheaton Precious Metals is a great company. You get a piece of silver, a piece of gold. You know, GDX, it's almost 6 of one, half a dozen of another, honestly. I'm not sure there's a big difference between those two assets, but other than the fact that you have less risk in GDX, right? Because if something goes wrong with Wheaton, okay, but maybe a little slightly more upside if Wheaton keeps leading the pack. So nothing wrong with both of those. All right, Faded Trader, thank you, Brett, for all the knowledge, wisdom, help. Oh, I appreciate that, Faded. Take care. Thank you so much for joining us. Okay, so Tech Monkey, you're buying the ETF because it's too expensive to buy all the individuals. But what I'm saying is you don't want all the individuals. You just want the one or two names that are leading that whole ETF, in my opinion. But obviously, I'm just sharing my thoughts with you. Do whatever makes you comfortable. That's the key. That's the key. There's nothing wrong with YOLO versus these other names, and do what you feel comfortable with, okay? All right, guys, listen, I appreciate the time tonight. I look forward to seeing you guys on Saturday. Same time, or no, 11:30 on Saturday, same station. All right. Have a great night, guys.